Morning. We are starting with the capital account. Sir, what do you mean by capital account? I have told you earlier that we prepare profit loss account, then we prepare profit loss appropriation account, and then we prepare capital account. Okay, right now capital account we prepare in two methods. There are two methods of preparing capital account: fluctuating and fixed. In fluctuating we prepare one, and in fixed account we prepare two account: capital account and current account. Sir, what?
Okay, for preparing this capital account, we have to first pass journal entry, and from these journal entry we can prepare capital account. Hope so you have remembered that in previous video we taught you about journal entry. You can refer that journal entry, and from that journal entry you can pass here. But without journal entry we can directly prepare capital account. I am going to show you this. Okay, let's start with a capital account. Before that I'll discuss with certain logic. Okay,
Modern method, that is to increase a debit we do debit, to decrease it we credit it, and credit balance, to increase credit balance we write credit, to decrease credit balance we write debit. You just remember this concept. This is very important concept. To increase debit balance we should do debit, to decrease debit balance we should do credit, to increase credit balance we should do credit, to decrease credit balance we should do debit. This is a very important concept in this capital account. Right now capital is our liability. Capital has a credit balance. Capital is a credit balance. Capital has which balance? Credit balance. Okay, remember one rules: debit all asset. All asset has which balance? Debit balance. And credit all liability. Credit all liability. Liability has a credit balance. You have to remember, cash account is a asset, it has a debit balance. Liability, capital is our liability, it has a credit balance. Similarly, a creditor has a credit balance because there is a liability. Bank loan is a liability because it has a credit balance. Liability means a credit balance, asset means a debit balance. Right now we have prepared profit and loss appropriation account, and we have given interest on capital, salary, commission, reserve, all this to the partner. All these we have given to partner. Interest on capital, salary, commission, not reserve. We have not given reserve to the partner, rather we have kept aside. It will be shown in the balance sheet, the liability side. Okay, reserve. Interest on capital, salary and commission we have given it, sir. Okay, right now come with the concept. Suppose partner has a brought down balance. It has a brought down balance. It will be given here, right? We will write here. Sir, brought down balance means that partner has started business with a capital of certain amount, and the account has been closed, and in next year what we will do? The next year the balance which has been left over in the last year will brought forward in this particular year. So it has a credit balance. If it has a credit balance, we will write here. If it has a debit balance, sir, how will get to know it has a credit or debit? It will be given in question. If question is not given, only given has a balance of 50,000, 60,000 like this, that means it has a credit balance. In case it will debit balance, it will write there in bracket debit. Then you have to understand that it has a debit balance. Okay, sir. Balance brought down, will write over here, credit side. Okay. Suppose A has made additional capital. Partner has made an additional. They can make additional capital. Additional capital means they have already invested certain amount in the business, and the business require more amount. Then the partner will bring more amount. That is by bank. It increases. Sir, why we will write here? Why we will not write here, sir? Credit capital has which balance? Sir, credit balance. And right now, suppose A has invested 1 lakh. Suppose A has invested 1 lakh. A has started business with a 1 lakh, and right now A will bring more 1 lakh rupees. So what amount of capital he has contributed total? Sir, 2 lakh, 1 lakh he has invested, 1 lakh more he is bringing. That means his capital balance is increasing. Yes, sir. So to increase credit balance, what we have to do? Credit. So we'll write over here. Okay. In similar way, interest on capital. Interest on capital means firm will give interest to the partner. Okay. Then firm will give interest to the partner, that means it will increase his capital, will write here. Salary will increase, will write here. Commission will increase, will write here. profit we have distributed to the partner A and B, this also we'll write here. That means interest on capital, salary, commission, profit, all these we are going to write in the credit side, because it increases the capital. We'll write over here. Okay, sir. Interest on drawing A and B, these interest on drawing I am going to write here. Interest on drawing I will write here. Clearly we will write drawing in the debit side. As I have told you earlier that we don't prepare profit and loss appropriation account in case of loss. Okay, you can see we directly adjust here profit and loss in the debit side as it reduces the capital. Similar in case of profit, where there is a profit and we prepare profit and loss appropriation account, we write in the credit side of the profit and loss appropriation account. Now you can calculate carried down balance also, balance brought down plus all credit side less drawing, interest on drawing, profit and loss, whatever will be left will be the balance carried down. Okay, we'll start with a fixed capital account. Sir, fixed capital account, in this we prepare two accounts, partners capital account and partners current account. See, the name itself suggests current means regular. All the regular item we will write in current account and all the irregular item we will write in capital account. Sir, it is similar. Just recall your fluctuating capital. Sir, in fluctuating capital, whatever we were writing in fluctuating capital, we will write here also, but we will bifurcate, we will segregate the item in two different account. One is capital account, another is current account. Sir, what we will write in current account? All regular. Interest on capital we used to write. Yes, sir, we'll write here in current account. You can see current account, commission, salary, interest on capital, profit on less appropriation. Right hand come to the debit side. When we come to the debit side, drawing, interest on drawing, profit and loss, all loss, profit and loss account, share of loss, and the balance carried down. Okay, sir. Sir, what about brought down? If it is given credit balance, we will write in the credit side brought down. If in the question it is given debit balance, we will write in the debit side. Sir, how can we know it will write debit if it will be debit? Otherwise, if nothing written, just assume it as a credit one. Okay, sir. So this is current account. What about capital account? Sir, in capital account we write irregular items. Suppose additional capital made by the partner. This is fresh capital. You can see we have to write in the credit side as it increases. The concept is same. Increase the capital account, increase capital account, so capital increases means credit side. Okay, and decreases means debit side. Similar way, bank, if we withdraw permanently, then it is we'll write in the debit side. What is the sir? There is a two type of drawing. Just listen, one permanent and one is temporary. Drawing which given in the question we regularly withdraw, and what comes in permanent account, question will be given like X has withdrawn 10,000 out of his capital or permanently withdrawn his capital. It will be given in question. That means it is a permanent withdrawal of the capital. And what about temporary? It will just written in the question drawing. That means you have to write in the current account. Okay. Hope you understood fixed capital and fluctuating capital also.